You're gonna take the lead?
Sure, I can try.
All right, let's see what you got. Now everybody has to check it, and here you go. There's your gift card for taking the lead.
Oh, they bang.
Whoever was brave enough to do it gets it. Good.
Okay, so
And hold on. I want everybody to either nod and go no. When he says something correct, it's yes. And if it's incorrect or if you have a different answer, I shouldn't infer that you're incorrect. If you have a different answer, let's find out why we have a different answer. Go ahead.
okay. So I started with asset number 5. So the basis minus the depreciation brings us to $430,515, and then I netted that against the proceeds of $500,000, and that gave me a gain of $69,486 under 1245 recapture. So I classify that as ordinary income.
How's everybody feel about that? Okay? Keep going.
Okay. And then the abandonment of asset number 4, I said I took the net book value, which is $23,240, and I classified that as an ordinary loss since there's no sale or exchange in that instance.
Everybody good with that? Okay?
And then, so because it's a loss, you'd have to go through the hurdles in this case.
How's everybody feel about that?
Did we need to take depreciation expense or not?
The only activity was
Okay.
do what?
There's depreciation on our page though.
Oh, you know what? I think you do have to take depreciation expense.
Because otherwise,
Otherwise, there's no law.
the income is so low if you don't.
No, that is right. Thank you, because again, I write this stuff, and I did hide that there on purpose, but I was like, nah. But yeah, that's 100% right. Because my curiosity as I was watching this unfold and I was doing the math, I'm like, this is the stupidest example I've ever seen in my life. Why did I do this? So the depreciation expense actually now makes that make sense.
Yeah.
As to what I did and why I did it. So it's the 69 minus the 252.
And 128. There's depreciation
Yeah.
for the building on the bottom left.
Okay. So who has that number in terms of what that net income would be?
380,
Yeah.
What did you say?
I have three.
I got
neg-
334.
Yep, 334, 530, 553.
Hold on. Let me write this down because
33.
there were a lot of numbers flying at me there.
Just do 333 for simplicity.
Yeah.
Okay, 333 per Matt and hotel guy.
That's fucking terrible nickname. So bad.
Okay. Now what?
Please do.
Okay, so where did the 333 come from again? I'm sorry. Yeah.
So let's do that. Okay. What was your net income number?
For
This sale.
the sale was 69,486.
486, and then my depreciation for the first asset was
What was that asset number 1?
252, 573.
252, 573, and then one what?
128, 205. And there's also a $23,000 loss.
Oh, 23 what?
240. It's rounded down.
Okay, so what's this real number?
334,533. I think.
Is everybody good with that? Okay. All right. Then what?
Okay, so then we have to figure out basis for each partner. So for item D, it says each of the shareholders owe $50,000 to the corporation to purchase the stock. So I assume that to be acquisition cost.
Yeah.
Okay. And so,
But if you look at the basis schedule, that's the first line of the basis schedule. Isn't that
I
right?
see. Oh,
Isn't that right?
that's 2015 basis.
Yeah, but that would be when they acquired it.
I see. Okay.
Okay. So the $150,000 note receivable on the balance sheet correlates to the $50,000. So this basis here, the 50, 50, and 50, everybody bought it for 50. correlates to the note receivable shareholder stock purchase of $1.50.
Okay. And I guess for this year, they start with $100,000 basis, so
Yep.
that's where we begin.
Yep, that's where we would begin.
And the only thing I could think of was, so Steph loaned the corporation $500,000. So that's to her basis. But AP would be for the first step, right?
It's an S corp, isn't it?
Oh, is it? No,
Did we say?
It was both.
it was both.
Oh, okay.
So it depends. That's kind of the point I got to personally.
Okay, so what do you think the next step would be? Who took a next step past where Luke got to?
So you divide 333 divided by 3 partners to get the K1 income allocated.
Okay, so we're going to stick with Matt's 333. We're going to say this approximates out to 333, right? Just for math. And what you're saying is, who is it? Steph,
Brett, and Kaylee.
Brett, and Kaylee. Okay, so now we got to take a journey for them. Is that right? Okay, so what's the next step?
So they each get $111,000 of loss allocated to them.
Okay? So this is at the beginning of the hurdles before we do anything, correct?
Yep.
Okay?
And then we got to figure out if we meet the hurdles. So we start calculating what our basis is and then at-risk basis.
Okay, so who do we want to start with, and are we going to do this for the S Corp first?
We can do S Corp first.
Okay, I don't care. You,
Yeah, that's where. That's good.
We can do S Corp. Yeah. Let's do Steph first.
okay?
So Steph has an acquisition cost basis of $100,000,
Okay?
and she has $500,000 of basis in the money she loaned to the S Corporation.
Okay, so for Steph, you're saying she has basis of 600?
Yep.
Okay? So does my 111 hop over that?
Yep.
It does. Okay? Then what?
And then
So now my 111's hopped over.
same process. We said both of them met at-risk basis.
Okay, so we have 600 at risk.
Yep.
The 111 hops over. Then what?
And then we figure out if she had a passive activity or a non-passive.
She passive or not passive?
She is passive.
Okay? So now, Steph is passive. What happens there?
Looking at the fact pattern, she also earned $150,000 in passive income. So we can, through netting, create a passive income of whatever the difference is.
39.
39.
39.
Yeah.
Okay? So she's able to use all of it off of the activity.
Yep.
So that's Steph. Who do you want to call in? Hold on. Stupid question. Does everybody follow what the hell just happened? What do you got, Luke?
So is the 600 part of the 100,000 like starting basis, then that or 500,000 of the note?
Yes.
And then
Because she lent the money to the company, right?
right, but in an S corp, would that be the case?
If she's the lender,
Okay.
it counts, the amount that you loan to the corporation counts for basis purposes. If you're a shareholder in one status, and then you're the lender in a second status, then you get to use the acquisition cost of the stock and the loan that you made to the company in determining what basis is for loss.
But if it's distribution, then it's not.
It does not. Only the status of shareholder acquisition cost counts for distribution purposes. Okay?
Go Jackson.
Oh, that looked malevolent.
No,
Just the
I
point.
got belief in him.
Okay. So Should we do Brett?
Sure.
Okay. So it's pretty similar, obviously, 111.
Yep.
So for Brett, we said that his basis is only his initial contribution because he doesn't have the loan. So obviously, whatever the math ends up being, he loses 11,000 of the loss based off that,
Doesn't lose it.
or he doesn't lose it, but it's until the
It's suspended.
basis is reinstated or whatever.
It's suspended.
Yeah. So then he was a active partner because he.
So that was just basis. So did you just lump basis and net risk basis into one thing?
Well, we didn't, but I kind of skipped over that because we said that, or he didn't. There was no at-risk basis differential.
There's not, but you still, I would say, need to do it.
Yeah. No. That.
Okay. So we have a $100,000 loss.
Yes.
Okay.
And he was active.
Okay.
He had 500 hours. So what we said is going to happen is he has $25,000 of W-2 income.
Okay.
So that is obviously going to be offset.
This is Brett, right?
Yes, this is Brett.
So for Brett,
So he's got a
he's a
W-2 is
W2,
25,
25,
and then the $100,000 loss.
K1
Yes.
of $100,000 loss
Yes.
equals $75,000 loss.
Right.
Okay.
And then is that, what do we consider that? That's one thing that we weren't entirely sure on. Like, is that just a $75,000 loss on his return, or does that meet the NOL thing?
So excess business loss. What characteristics do we remember about excess business loss?
There's a threshold or whatever.
Limited at like 305. Yeah, 305.
305 for single, and 610 for married joint. Well, it doesn't matter because he's under both thresholds, and he's able to take that loss. But if he has no other income, that's just going to be automatically an NOL going in the next year
Okay, so it would technically be a, yeah.
by virtue of fact pattern. Okay. So what about Kaylee?
Wait, so is it in that?
So for Kaylee, similar situation to Brett, where she has 100 of tax basis, and then the at-risk basis is the same for her.
Okay.
So then we get to the next step. She's not passive either because she has 750 hours.
Okay.
And her situation's a little different because she has 300,000 of W-2 income. And we took the whole thing since it's under the threshold of the business loss.
Is that what everybody has? Does that make sense to everybody? On some level? Because at the end of the day, Brad, is this a useful section?
Yes.
It is. So stupid question, if it got hung up at the at-risk, what's the form, Max?
Yeah, 5.
Nope. Jackson?
6198.
6198. Connor, if it gets hung up at passive, it is
I have it highlighted.
hotel guy?
8582.
8582. You are now in perpetuity the hotel guy. We got noodles and hotel guy. We got Tito's. We got pot smoker. We got all sorts of things. Okay. Okay. So, hold on. Was that a useful exercise? Yes or no?
Yes.
And you can now see the moving pieces, maybe a little bit.
Yes.
Okay. So I want to spend a couple minutes on this page. And if we have the endurance and we give a shit and we have the time, we'll come back and visit this because this is important. I don't want to say that this is not important. However, the other stuff that I think I want to cover is slightly more applicable to your world. So I probably want to spend a little bit more time on that. So this section is choice of entity. And this grid that you have here is a compare and contrast as to what a choice of entity looks like. So, or the choices, the trade-offs that you're making in terms of if you choose a particular path. So a Schedule C or a single member LLC owned by an individual is all the income subject to SC tax. What does SC tax mean?
Self-employment tax.
Self-employment tax. Everybody on board with self-employment tax? Know what that means? Okay. If you die, is there a basis step up in the assets owned by the Schedule C or the single member LLC? There is. Income allocation is all allocated to one owner. Can the shareholder / stakeholder, partner, get a W-2? No. Is there an equity interest? No. Asset movement taxability. Okay, so what I mean by that is, can I title something to my Schedule C and can I take it away from the Schedule C without any sort of tax impact? So if I own a piece of ground and I transfer it to my Schedule C, is that a taxable event? It is not. If I take it back out of the Schedule C, is that a taxable event? It is not. So the movement of assets in and out of a Schedule C has very little, has no impact. Interaction with debt. Do you have debt basis? Yes. Unreimbursed expenses. That counts for a Schedule C. You'll see when we talk about S corps that when you do a compare and contrast, that's not the case. Acquisition indebtedness, interest, yes, you get that. So for a partnership, subject to SC tax, yes, if you're an active partner. And kind of yes, if you're not, because of the net investment income tax. They kind of have now gotten you because of the net investment income tax on, with respect to partnerships if you're passive. Basis step up. Step up in base partnership interest if a 754 election is filed. Hotel guy, I swear to God that's going to stick. Do you know what a 754 election is? Basis step up?
Yeah, I do, but it's hard to articulate.
Okay. CV?
I don't.
Sam? Okay. That's one of the things we are talking about today. Okay. So what that means is if somebody dies or somebody buys a partnership interest and there's no inside-outside basis difference to the seller, can you adjust the inside basis for the purchase of the asset? So let me tell you what that means differently. I contribute, and it's going to be a single person partnership. I contribute a piece of ground to the partnership. That piece of ground has $100,000 of basis. When I contribute, then my equity interest in the partnership has $100,000 interest. So if I sell my partnership interest for $1 million, I have a $900,000 gain. If my partnership sells the piece of ground for $1 million, it has a $900,000 gain, and that the K1 is issued to me, and I have a $900,000 gain. So that is the case. Pat Knowles, who none of you know, used to say, if you want to sound smart, confuse the person in front of you and get out of a sticky situation, just say inside-outside basis difference, and they'll look at you like, what the hell are you talking about? In this case, the outside basis was $100,000, the inside basis of the land was $100,000. So a 754 says that if I sell my interest to Max for $1 million, my partnership interest, when we say acquisition cost, what is Max's acquisition cost in the partnership interest he just purchased for me?
$1 billion.
$1 million. What's the inside basis of the ground inside the partnership?
100,000.
100,000. Okay, so now there's this disparity in between the inside basis of the ground and the outside basis of the partnership interest. 754 says, well, wait a minute. We're going to allow you to step up the basis of the asset inside the partnership even though that was not what was bought or sold. So now Max gets $1 million basis in that ground when it sells. It's not quite that simple. That's way too simplified, and I'm going to demonstrate that. But that's what 754 is and basis step up is. Flexible from a partnership agreement. The wonderful things about a partnership is they are flexible. If Connor, we'll go with C squared, the two Connors. If the three of us got into a partnership, we could say the first $1 goes to me, the first $10 goes to CM, the next $10 goes to CV. After that, $100 goes to CV, and the next $2,000 goes to CM, and $4,000 goes to me. A partnership, you can do whatever it is that you want to do, and you can write whatever rules that you want to in a partnership agreement to do whatever wacky thing you want to do to get an agreed upon economic agreement. That's the beauty of the partnership agreement. The worst thing about a partnership agreement is you can write it that way. Because the thing about an S Corp is, an S Corp, I'm going to describe it as a memory. It really doesn't have a memory. Every dollar that's owned by an S Corp on an annual basis is going to be allocated to each member of each shareholder of the S Corp on a per share per day basis. It's linear. There's nothing else that you can do about that. A partnership requires you to have a memory. A partnership has to say, on that goofy thing that I just did with me and C squared, is that, well, the first $1 went to me and $10 went to you, right, Connor? And then $10 went to Connor, and then was it 100 went to you? So we made $32. Well, the first $1 went to me, the next $10 went to Connor, the next 10 went to Connor, so we're up to 21. 11 went to Connor, but we owe him 100, which means there's $89 next year that goes to Connor if we earn $89. So not only do we have to know what is happening this year with respect to what's going on in a partnership, we have to remember what happened last year. And if a partnership agreement is written to say it's a third, third, and a third, well, you don't have to have memory at that point. You can just divide it up a third, third, and a third. But the more you take advantage of the flexibility of a partnership agreement, the more traumatized you're going to be. Can you have a W-2 for a partnership? No. Equity interest, flexible. Okay, what I mean by that, and actually you might want to give that a little bit of an asterisk, is when I say flexible, it goes exactly to what I just said. I can make income allocations vary any way I want and have whatever wild, crazy idea I want, and on top of that, and this is actually pretty nice for a partnership. If Jackson and I are partners in a partnership, and we start with $1,000 in the partnership, and we do really, really well, and it's now worth $10 million because we got an appraisal from Lutz M&A, we can say, Max, you've been doing great things for us. We're going to give you a profits interest in the partnership. The profits interest is going to say that if we sell the company for $10 million, you get zero. If we sell the company for $110 million, anything above that $10 million number, you're going to get 10% of it. It's called a profits interest. And the reason you write that way is because if, in an S Corp scenario, if we had $10 million of value and we give him 10% of the company, he'd have $1 million income event today because you have a per share per day basis. It's linear. There's no way you can get around that. In a partnership context, you can make the partnership where, well, we get the 10, shield you from that income event because you didn't get any equity, and then anything, that $100 million appreciation, you get 10% of it. Here's your $10 million. Okay, so there's all sorts of flexibility with respect to how an equity interest would work. Cash is distributed. If any assets are distributed, it's flexible. Interaction with debt, yes. Unreimbursed expense, partner expenses. I said earlier in the thing that we talked about the acquisition indebtedness for S Corps and partnerships. And I said unreimbursed expenses for S Corps, no good. Partnerships, if you have an unreimbursed expense as a partner, then you can take that on Schedule E. against your deal. Acquisition, that is sure. S corp, SE tax, no. That's the huge advantage. If you make $1 million and it's a partner in a partnership, all of it's subject to SE. If you make $1 million in the S corp and take a $100,000 W-2, only the $100,000 W-2 is subject to the SE. The $900,000 remainder is not, which is, $30,000 worth of tax savings. Basis step up, you only get a basis step up in the shares. So in that $100,000 754 example where I had $100,000 and Max bought it for $1 million, that, and going back to the estate tax discussion that we had before, any item going through an estate is going to have a fair market value associated with it, correct? So I die, my partnership interest transfers, and you have that $1 million value, the 754 will step up the basis in the asset. I die with an S corp interest, or shares, goes to my estate. The shares in the S corp go up to $1 million, but the land inside stays at 100,000. You don't have that opportunity in an S corp to equalize basis the same way you do in a partnership. Equity interest means it's rigid. Going back to if I have $10 million, if Jackson and I have $10 million, we transfer 10% to Max, he's going to have $1 million income event. Asset movement. Once you put something in a corporation, it's stuck there forever. Debt interaction, not good with an S corp. Unreimbursed expenses, not good with an S corp. Acquisition indebtedness, you can take it to Schedule E, as we talked about. Okay, so choice of entity is pretty important. With respect to C corps, I'm not going to spend any time with it. I don't care. For purposes of what we're dealing with, I think we have more important things to be doing. So with that said, I think we're going to move on to a new topic.